There is a particular quality of silence that descends upon a market the moment before something important happens. Not the silence of absence, but the silence of accumulation, the kind that precedes a thunderstorm when the barometric pressure has been dropping for days, and every creature with instinct sharper than a spreadsheet already knows what's coming. Silver produced that silence this week, and then, on the first day of May 2026, it broke it. The metal closed at $76.26 on Thursday, up 3.47% in a single session, one of the most decisive single-day recoveries this market has witnessed since mid-April. But the number itself, the dollar figure stamped on the ticker, is almost the least interesting thing about what happened. What matters, what the casual observer will miss entirely while the experienced one leans forward in his chair, is the story of how silver arrived at that moment, and why the geography of that bounce is more revealing than the bounce itself. Cast your mind back only 1 week. Silver was trading comfortably in the $75 to $77 range, neither sprinting nor retreating, holding the kind of disciplined middle ground that markets occupy when competing forces have temporarily exhausted each other. Then 2 events arrived in rapid succession, the kind of confluence that doesn't announce itself in advance, but announces itself loudly in retrospect. The Federal Reserve, in what will almost certainly be remembered as Jerome Powell's final significant act as chairman, held interest rates unchanged on April 29th. The market had anticipated that. What the market had not anticipated was the vote count. 4 members of the Federal Open Market Committee dissented, a number not seen at that scale in over 3 decades. 3 wanted to remove any language suggesting future rate cuts. 1 wanted to cut immediately. The institution that is supposed to speak with authority about the direction of monetary policy instead revealed something it almost never reveals: genuine, fractious, unresolved internal disagreement. Markets heard that clearly. What they translated it into was this: inflation remains a problem, rate relief is further away than previously assumed, and a metal that pays no interest becomes measurably less attractive when the alternative is a government bond yielding something real. Traders sold. Then, as if the Fed's internal confusion were not sufficient headwind, the geopolitical architecture of global energy added its own weight. The United States rejected Iran's latest proposal to negotiate the reopening of the Strait of Hormuz, that narrow, irreplaceable waterway through which roughly 20% of the world's oil must pass. With talks collapsing again, crude oil surged. And here is the chain reaction that most casual observers of silver never quite follow. Elevated oil prices stoke inflation fears, which push rate cut expectations further into the future, which strengthens the dollar, which suppresses the price of a commodity priced in that dollar. Silver fell from the $77 range all the way down to $71, its lowest point in a month, in the span of just a few trading sessions. And then it bounced. Not tentatively, not apologetically. It bounced with the kind of conviction that leaves a mark on a chart and a question in a thinking investor's mind. Here is what that question is, and why it matters so much more than whether you check your silver position every morning with hope or with dread. The $71 level, and more broadly the zone between $71 and $73, has now been tested 3 separate times this market cycle. In March, sellers pushed silver toward that floor. Buyers appeared. In mid-April, sellers pushed again. Buyers appeared again. And this week, with arguably the most powerful macro headwinds of the entire cycle bearing down simultaneously, a hawkish Fed surprise, an Iranian standoff, a strong dollar, oil prices elevated, sellers pushed a 3rd time. And buyers appeared a 3rd time. In the language of markets, a price level that absorbs repeated assault without breaking is not merely a number. It is a statement about the balance of conviction between the people selling and the people buying. Every failed attempt to break that floor strengthens it, not because of any mystical property of the number itself, but because the failure is visible, remembered, and acted upon by an ever-growing constituency of participants who have seen what happens when silver reaches that territory. They know what has happened twice before. They come prepared. If you have been holding silver through this correction, watching it fall from the extraordinary $111 to $113 range it touched in late January, back through $90, through $80, and now consolidating in the $71 to $76 range, you already know what this moment feels like. It feels uncertain. It feels like the market is testing not just the price, but your conviction about the price. And that feeling, that specific discomfort, is precisely why most people make the wrong decision at exactly the right moment. They confuse the turbulence of the journey with the direction of the destination. Stay with me, because what comes next is the part that almost nobody is talking about, and it may be the most important signal in the silver market right now. Before we go further, if this kind of analysis is the reason you come back to this channel, if the clarity of understanding what is actually happening beneath the surface of these market moves is what you value, then hit that subscribe button right now, because the next few weeks in silver are going to produce more noise, more confusion, and more emotional whiplash than almost any period this year. And you are going to want a framework for thinking through it, not just a daily dose of breathless headlines. Subscribe, and let's continue. There is a concept in the study of commodities that does not receive nearly the attention it deserves, and it is this. There are, in any functioning commodity market, at least two separate markets operating simultaneously, speaking different languages, responding to different signals, and often arriving at radically different conclusions about the same underlying reality. Silver is currently the most vivid illustration of this phenomenon available to any investor paying attention. The first market is the paper market, the world of futures contracts traded on the COMEX exchange, of ETFs that allow institutional and retail investors alike to hold an economic interest in silver without ever setting eyes on an actual bar of the metal. This market responds with extraordinary sensitivity to interest rate expectations, to the strength of the dollar, to oil prices and their implications for inflation, to geopolitical headlines and Federal Reserve minutes. It is, in the most literal sense, a market of opinions about silver, rather than a market of silver itself. And right now, that market has been expressing a cautious to bearish opinion. Short-term traders have reduced their exposure. ETF outflows have continued. The macro environment, higher expected rates, a firm dollar, persistent inflation anxiety, has made silver's lack of a yield feel like a handicap. The second market is the physical market, where actual silver, real and tangible, changes hands between industrial buyers who need it for solar panels, electronics manufacturers who require it for circuit boards, central banks and sovereign wealth funds in emerging markets who treat it as monetary insurance, and long-term institutional investors who understand that the arithmetic of supply and demand does not negotiate with futures traders. This market responds to a different set of signals entirely, and right now, it is telling a story that is almost the mirror image of what the paper market is saying. China imported 836 tons of silver in March, a figure that stands 173% above the 10-year average for that month. That is not a rounding error. That is not seasonal noise. That is a manufacturing economy signaling, through the most concrete possible mechanism, the actual movement of physical metal across borders, that its industrial appetite for silver is running at a pace that the global mining industry cannot come close to matching. The Silver Institute has confirmed that the world is consuming approximately 46 million ounces more silver in 2026 than it can produce from its mines. COMEX registered inventory, the actual physical silver available for immediate delivery on the exchange, has been sitting at what qualified analysts describe as stress level coverage ratios for 6 consecutive months. Now here is the historical lesson that commodity markets teach, with considerable regularity, to anyone patient enough to observe it across cycles. When the paper market and the physical market tell opposite stories about the same commodity, one of them is capturing a temporary condition, and the other is capturing a persistent underlying reality. And the direction of eventual reconciliation, the direction in which the gap closes, has historically, reliably, run from the paper price toward the physical truth, not the reverse. The physical reality does not ultimately bend to the opinion of futures traders. The futures traders ultimately bend to the physical reality. The bounce from $71 to $76.26 that occurred on May 1st may be, and I choose that word with deliberate care, it may be the first visible sign that the paper market is beginning to hear what the physical market has been saying with increasing volume for the better part of 6 months. Add to this one more technical data point that deserves more than a passing mention. Traders use a measurement called the Relative Strength Index, the RSI, to assess whether a market has been pushed down too far too fast. When the RSI falls below 30, it signals that selling may have grown excessive relative to the speed at which prices moved, and that some form of stabilization or recovery is statistically more likely. As silver touched its lows near $71 this week, its RSI had fallen to approximately 32, right at the edge of that oversold threshold. It is not a guarantee of anything. Markets can remain oversold longer than patience permits. But when an oversold RSI reading coincides with a third test of a proven support zone, 2 independent signals are pointing in the same direction simultaneously. That is not coincidence. That is the market, in its own oblique and maddening way, trying to tell you something. The institutional forecasters, and one may disagree with their precision while respecting the seriousness of their analysis, have not abandoned silver. Bank of America has maintained a scenario range extending toward $300 per ounce by year-end. Citigroup holds a $150 target. Deutsche Bank sees $100 by year-end. JP Morgan's consensus forecasts silver averaging $81 for 2026, above where it trades today. These are not the predictions of newsletter writers operating from basements. These are the research divisions of institutions that manage trillions of dollars in assets and whose analysts understand, perhaps better than anyone, what a 6-year structural supply deficit combined with accelerating industrial demand eventually does to a price. The bounce from $71 to $76 is consistent with every one of those forecasts, not because it proves them right, but because it is consistent with the sequence of events those forecasts describe. A correction of roughly 35% from the January high near $111, a consolidation around a defended support level, and then, as the macro headwinds that created the correction begin to ease, a recovery toward the structural mean that the physical market has been insisting upon all along. Let us speak plainly about 3 scenarios, because clarity is more useful to you right now than comfort, and because the difference between these 3 outcomes will be determined not by anything you or I do, but by a handful of macro variables that will resolve themselves over the next 2 to 4 weeks. The first scenario is continuation. Silver holds its bounce above $74 to $75, consolidates that ground over several sessions, and then pushes toward the next meaningful resistance level around $79 to $80, the zone from which the late April breakdown began. What causes this? Oil pulling back from its recent elevated levels toward the $80 to $85 range on any credible diplomatic movement regarding the Strait of Hormuz. The dollar softening even modestly. The April non-farm payrolls report, which arrived Friday morning, showing some cooling in the labor market, enough to bring rate cut expectations incrementally closer without triggering recession fears. Or any early signal from Kevin Warsh, who has cleared the Senate Banking Committee and whose full confirmation as Federal Reserve Chairman is now weeks away, about his philosophical approach to monetary policy. You do not need all of these. 2 of them, working together, could be sufficient to give silver the momentum to establish $76 as a floor and begin a genuine recovery toward the $85 to $90 range that multiple institutions have identified as a reasonable medium-term target. The second scenario is the false bounce. Silver advances from $71 to $76, exactly as it has done, and then stalls. It probes toward $77 or $78 over the next week, and then begins gradually to fade. The macro headwinds reassert themselves. The jobs report shows continued labor market strength, removing the Fed's primary justification for considering rate relief. Oil stays elevated. Iranian talks produce no new developments, or worse, deteriorate further. Warsh, in his first public statement as chairman-designate, signals that he will prioritize inflation credibility over accommodation, a choice that would be institutionally defensible but immediately bearish for silver. In this scenario, the bounce is real but not decisive. Silver finds itself in an extended consolidation between $71 and $78, neither breaking down nor breaking out, while the larger forces that will ultimately determine its direction continue their slow, subterranean work. This is, if one is being honest about probabilities, the most likely near-term outcome. Not because the structural story is flawed, but because the catalysts required for a sustained advance have not yet fully arrived. The third scenario is the one that holders of silver have been waiting for since January, the one that begins with exactly this kind of bounce from exactly this kind of support level, and then accelerates. Silver clears $79 to $80 on strong volume, holds above it for several consecutive sessions, and then drives toward the March high near $87. And from there, if conditions sustain, back toward the $95 range where it traded for much of February. What causes this is not complicated. It requires 2 things happening in the same 2-week window: a genuine breakthrough in the U.S.-Iran standoff that allows oil to fall sharply back toward $80 or below, and a signal from Warsh that the Federal Reserve's direction of travel under his leadership is toward accommodation. If those 2 things happen simultaneously, silver does not drift higher. It moves with the sudden, powerful conviction that markets reserve for moments when 2 large forces reverse direction at the same time. The structural physical story, which has been pressing upward against the paper market's bearish positioning for months, would find its catalyst, and the gap between physical reality and paper price would begin to close, rapidly. Watch oil every morning before you watch silver. The two are joined at the hip by the Iran situation and the Strait of Hormuz, and oil is the leading indicator. Watch the $74 to $76 zone on silver itself as the immediate battleground. Above it, the bounce has credibility. Below $71, the floor may be genuinely breaking. And watch Kevin Wersch, who has replaced Jerome Powell as the single most important individual in the monetary policy universe for precious metals investors, with a degree of attention proportional to the stakes involved. But there is something beyond the charts and the scenarios and the RSI readings that deserves to be said plainly, because it is the thing that most financial content never says. Markets are not just mechanisms for price discovery. They are mechanisms for emotional pressure. And the pressure that silver holders have been subjected to since that January peak, watching a metal fall from $111 to $71, a decline of roughly 36%, against a backdrop of continued structural tightness in the physical market, that pressure is designed, whether intentionally or not, to shake out exactly the people who are right for the wrong time horizon. The short-term paper traders who sold on the FOMC hawkishness and the Iran headlines were not wrong about the short term. They were right. Those were genuine headwinds. But the physical buyers who showed up at $71 this week, the industrial manufacturers, the long-term institutional investors, the sovereign buyers from China who imported 836 tons in a single month, they were also not wrong. They were right about a different time horizon. Both groups can be correct simultaneously. The confusion arises only when you forget which group you belong to and start making decisions appropriate for the other. Silver began 2026 at $71.59 per ounce and surged to $111 by late January, a gain of roughly 56% in less than a month, before correcting back to where it trades today. That is not the behavior of a broken market. That is the behavior of a market with enormous underlying tension between supply and demand, expressing that tension through extraordinary volatility in both directions. The signal in this week's bounce is not that the correction is over. The signal is that the floor is real, that the physical buyers are present, and that the macro forces pressing silver lower are specific, identifiable, and crucially, temporary. The Strait of Hormuz will reopen. The Federal Reserve will, under some chairman at some point, cut interest rates. The structural supply deficit will not resolve itself in the next 6 months. Mine supply cannot meaningfully respond to price signals for 7 to 10 years. The arithmetic of that situation points in one direction over the relevant time horizon. The bounce from 71 to 76.26 on May 1st, 2026, happening on strong volume from a level tested and defended 3 separate times, with an RSI reading that had reached the edge of the oversold threshold on the first trading day of a new month, is what that arithmetic looks like when it briefly surfaces above the noise of daily market mechanics. It is the physical reality of silver announcing, quietly but unmistakably, that it has not forgotten where it was going. Now it is your turn. Leave a comment below, holding, buying, or waiting. 3 words. Because the people watching this market from the sidelines and the people holding through this correction are making very different bets, and understanding which camp is larger and why is itself a form of market intelligence. Tell me where you are. I read every one. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.